Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're talking with Robert Sinn, also known as Goldfinger on CEO.ca and CeoTechnican on X/Twitter. Also, Robert is the publisher of Goldfinger Capital on YouTube, puts out some great videos, and he also, same moniker, Goldfinger Capital on Substack, and we were just talking off mic about all the articles that he writes to his subscribers and videos that he makes, so I definitely recommend clicking on some of the links below in the show notes after you listen to this and checking out some of Robert's work. Robert, great to have you on the show as always. Let's dig into the macro first. Obviously, since we've talked last in February, the world's a lot different place. We've got all kinds of stuff from the tariff wars, the export bans on certain minerals out of China. We still have issues with export bans on uranium with Russia, back and forth. We've got all kinds of executive orders coming out, proposed executive orders and orders that have actually come out, two of them on critical minerals and on the mining sector. There's just a flurry of different global positioning. Currencies have been gyrating, bond markets have been wild. Some of these moves have been counterintuitive. So I don't know where you want to go out of that stew of factors, Robert, but when you look at the macro situation, where are we? What's your assessment here today?
Thanks for having me on. Yeah, that is quite a stew of macro. And yeah, this has been a wild month. I mean, just put into perspective, think back to April 1st, Shad. So we know what happened April 2nd at 4 p.m. on the White House lawn and everything that's set off. But just think back to April 1st and all that's transpired in the last 24 days. It has been a whirlwind with every possible permutation for markets and news headlines and emotions that you could possibly imagine. Look at where we started and look at where we are today. You know, it's very interesting sometimes to just maybe even take the weekend to put things into perspective. There's a lot to unpack there. And frankly, there's so many moving parts still, and it's unclear where all this tariff stuff and trade deals are headed exactly. But I think that we can take some guidance from, markets. I mean, in early April, copper was just coming down from $5 a pound on its way to crash all the way to $4. But yeah, it was around $4.90 or $5 at the beginning of the month, and here it's at $4.88 in the same ballpark today. So there's been a lot of volatility, even some panic and capitulation, but here we are, we're right back there. So I think we need to, as investors, we need to see through this ocean of noise and apparent turmoil. And maybe it's not quite as tumultuous as it appears, right? And I think Dr. Copper is sort of sending us a very strong signal there. And gold has done us well in the month of April, and yes, it's been volatile as well. It's had some wild moves, including just this week to the downside, but not to be unexpected. I mean, when you see gold go from 3,000 to 3,500 in a couple of weeks, I think any veteran observer is going to say, "Oh, that's too far, too fast. It's probably time for a correction." And so that's exactly what we're getting now. But $3,300 gold or even $3,250 gold is not too bad, especially considering that we were at 2,700 just at the beginning of the year. So I think we need to see through all the turmoil and headlines and stick with what's working. And metals continue to work well.
Well, and I want to get into metals, but before we do, let's just quickly survey the land as far as U.S. equities, bonds, and the U.S. dollar. Over the last month, like you say, just in the last 24 days, it's been wild to watch the equity markets. I mean, they were already in a kind of a corrective mode this year, but they were kind of bouncing back and then completely fell out of bed. Now they've done a rebound all the way back up. Bonds, you would have thought, would have offered a safe haven bid to counter that move, but they also sold off and rates went higher. And you would have thought, okay, well, then at least people could go to the U.S. dollar. But they really didn't. The U.S. dollar has sold off. So you've kind of seen a sell America, shun American assets trade globally. That might be from people living here in the U.S. domestically or from foreign investors. It could be a combination of all the above. But the normal safe havens didn't ask as safe havens, and gold really stood out as the safe haven. But what's your take on, just before we get into the metals, the U.S. equity markets, bonds, and the dollar, just from a big picture standpoint?
Yeah, so that's a great question. And the dollar, I think, is the simplest one to talk about, and it's probably the most important one. So never before has a US president talked down the dollar like Trump has talked down the dollar, literally attacking the chairman of the Federal Reserve on an almost daily basis with tweets. Now, it seems like he's walked that back a little bit in the last couple of days, and that may also be why the dollar has calmed down a bit here this week, and stocks seem to be a little more buoyant and well bid. He may have had some advisors tell him that he just can't keep doing this, and he decided to agree. But Trump is a moody guy, so things could change again next week. But it's clear that this administration in Washington does not desire a strong dollar. I think we can all agree on that. Now, the dollar cannot just drop 20% or 30% in a week, without causing major problems across markets and the global economy. So it's going to be a process, but the trend is lower. And I believe the trend in the US dollar index will continue lower for the rest of this year. I think that's one of the simplest trades that we can make out there, and trends that we can follow, quite frankly. But again, markets don't move in straight lines for extended periods of time. They might move in straight lines for a day or a few days, but then they need to diverge a little bit and shake some people out. So that's probably what's about to happen with the dollar. Maybe a little bit of a counter trend bounce here in the near term, but big picture, the trend is lower, and that's one of my major themes for 2025. Obviously, what we saw in the Treasury market earlier this month was very unsettling, and it was not that flight to safety trade into treasuries that we are, accustomed to when the stock market is getting unhinged and volatility. The VIX is spiking above 60. Normally, it would be a risk-off flight to safety into treasury bonds. That didn't happen really earlier this month, and there's some very good reasons for that because of some of the drivers of this market volatility. That the reshaping of the global trading system, the global financial system, and maybe some questions about the U.S. and is it really the cleanest dirty shirt in the laundry around the world, right? And so there were some questions there. Things have calmed down a bit. Again, they've calmed down a bit, and that I think explains why the VIX is now back to 25 after spiking above 60. But I think we can assert the dollar is trending lower. Treasury yields are probably going to trend lower over time because that's what policymakers and the powers that be want to see happen. So they'll find a way to engineer that. And then in terms of equities, this is much harder to gauge because now it seems like it's a sudden consensus to sell the US, get out of the US, don't own American stocks. The Economist has this fallen eagle, the wounded bird on its headline this week. So just purely from a contrarian perspective, I'm bullish in the near term. That could be a day, a week. I think maybe there's more dead cat still left in this bounce here. But bigger picture, I tend to agree that this rally is one to be sold. So maybe it will continue for another week or two, but then maybe it's going to be sell in May and go away again, with these, U.S. stocks. And it is time to diversify a little bit. I'm not sold on Europe, but maybe Canada, maybe Australia. Hopefully we'll see some positive in Canada once the election is done next week. I'm cautiously optimistic on the countries with the resources, Canada and Australia, with rule of law, speak English, et cetera, et cetera. There's lots of reasons to like those two nations. And then I think if you want to get a little spicy and risky, Argentina, there's some positive change that's happening there. And lots of, resources there in the earth in Argentina. So I believe that it is time to diversify a little bit and go abroad. Having an all U.S. portfolio just doesn't make sense anymore.
Yeah, I think that's a good point. And I think a lot of people have gotten tunnel vision, especially over the last 15 years, but even the last couple of years, where the evidence by the Mag 7, people having such a narrow market breadth just into US tech at the exclusion of almost all else. There's a lot of other global markets out there. There's other countries doing interesting things, like you just mentioned with Argentina and possibly the resource countries like Australia and Canada. But really, there's a lot of people that have piled into Europe and China and different markets that have done well. People have been back and forth on Japan, but it's just interesting that we get so stuck on U.S. markets all the time. And they are the biggest markets in the world. At one point, the U.S. markets had more money than all the other global markets combined. So nice to see it maybe spreading out a little bit more breadth into the global marketplace. But all of this has shaken investors to the point where I think there's still a lack of certainty. And we only have a 90-day pause in the tariffs, and it's only on some tariffs. And then there's exclusions. So there's so many moving parts, as you mentioned, that a lot of people are still uneasy. And so the thing that's really stuck out, as we mentioned, is gold. Gold has acted as the safe haven. It did its job. It's not got the counterparty risk to other countries. And above 3,000 was probably coming a lot sooner than some people expected. It's not a surprise, but just coming sooner in the year than a lot of people anticipated in 2025. And then bouncing all the way up to 3,500, which was short-lived. Now we're in the 3,200 to 3,300 range. What do you make of gold as far as being able to hang on to these gains? What are the macro forces behind gold right now outside of this volatility? Is it central banks? Is it Western investors? Is it Eastern investors? What's moving the yellow metal, Robert?
Good question there. So unpack. So first of all, keep it simple. We know that central banks are the main driver of gold. Okay, so we can all assert that. We can agree on that. Central bank buying is what has driven gold from 1,800 to over 3,000 in the last 3 years, right? Now, so from an investor standpoint, we can all agree on what the price is today. We can all agree on where the price has been in the past. We can all look and say, well, we bought it at 1,500. It's now 3,200. I have a big profit. Question, has anything changed in my thesis, and should I sell and take profits here? And so when we delve into that question, we need to think about, okay, what are the drivers that could move this higher in the future or move it lower in the future? And you need to think about central banks. Number one, first and foremost, is anything going to change in terms of central bank appetite for gold? And really, I can think about that 10 different ways, and I keep coming with the same answer. They're going to keep buying gold for many more years to come. China still doesn't have as much gold as it would like to own. Obviously, there are some questions about how much they really do own, and certainly the Chinese people, the private gold ownership is very strong in China. But I still think there's going to be a lot more. It's a huge country, 1.4 billion people, and a huge economy. In some ways, it's larger than even the U.S. So they have an almost insatiable, appetite for gold. And then other central banks, Turkey, Poland, smaller countries continue to accumulate gold as a backstop to their central bank and to their currency and financial system. And that's not changing. And even, much smaller countries and economies, but smaller African countries are actually starting to, their central banks are starting to buy gold. And Africa is an emerging market that will become a more important part of the global economy in the decades to come. So I see nothing but more central bank buying. And then, maybe that's already priced in at 3,300 or certainly 3,500. I'm not sure. Maybe somebody can make an argument for that. But now we have more institutional investors looking at gold. And this is still very early days. A lot of institutional investors have zero gold exposure. They certainly don't have any physical gold. And they are diversified. This is part of this diversify away from the dollar and treasuries trade that is just beginning here in early 2025. And when you think about the size of the U.S. equity market, And the size of the U.S. Treasury market, which I don't have the numbers off the top of my head, but we're talking about tens of trillions. And even if 0.1% of that leaves where it's been before and moves into gold, well, that's a huge driver. And certainly a 0.5% would be a market mover in a big way, and 1% would be, gold would be about 5,000 probably, right? Because these are very large pools of capital, right? And so that's what we need to be thinking about, that U.S. Treasuries, this risk-free asset that we've learned about. Everybody who went to business school in the last 50 years, anywhere in the world, learned that the U.S. Treasury is the risk-free asset, and that's the risk-free interest rate. When there's some question about the risk there, and that it is no longer this perfect asset, and there is some risk and uncertainty there in terms of maybe even a debt restructuring coming by the U.S. Obviously, it's still early days there, and there's a lot of uncertainty there. But even just to have that conversation is extremely dangerous, and makes gold look way more attractive to a whole new set of investors. And we could keep going, Shad. The case for gold is very compelling long term, but I also don't want to just sound like a perma-bull here. It's had a big move. 2,700 to 3,300 is a very big move, no matter how you slice it. And frankly, as a gold bull and very biased person who wants to see gold trade higher, I would love nothing more than to see gold cool off for a couple of weeks here and trade, let's say, 3,200, 3,300, and just get a little boring again and get its name out of the headlines. That would be fantastic.
Agreed. And I think we've had other people on the show this week saying the same thing, that we don't really want a parabolic move, because those end in tiers where people are holding the bag and it goes down the other side of the parabola just as fast as the front side of it. You want more of a measured move, and you don't want it to be in the headlines and being called a crowded trade, even though I don't think it's a crowded trade. The fact that it's making headlines like that, you want to kind of see it cool its jets. And it has some from 3,500 to the upper 3,200s at the time of this call, but it'd be nice to get it back to being boring. But what we want to see get exciting, Robert, are the gold stocks. And so at these prices, we're substantially higher in Q2 than the average gold price in Q1. Now, we're just starting to get Q1 earnings from some of these companies. We just saw Newmont's come in. We can maybe dig into that. But I think the average price in Newmont's earnings was around $29.44, their average selling price. Some companies are going to vary a little bit there depending on what they sold gold for over the quarter, but we can say around 2,900 plus is a good number. Look at where we are in Q2, and we can also note that Q1 substantially higher from Q4. So we're seeing a trend of quarter after quarter, higher earnings, a higher gold price. Costs haven't crept up as fast as the gold price has, so the margins have expanded. How are you looking at the gold stocks, the Newmont earnings? Anything you want to say about earnings from these gold producers?
Yeah, it's interesting because the Newmont quarter was something that I was following pretty closely this time. And, Q1 is usually not the best quarter for that company, or even for most senior gold mining companies. So, I wasn't expecting a blockbuster report, but certainly the $300+ increase in their average gold selling price was going to mean some pretty good numbers were coming. But also, it wasn't just that. It was actually a little bit of a drop in oil in Q1, so they saved a little bit on the cost side. Silver prices were a little higher. Copper average selling price was also a little higher. They mine both of those metals as well, and they're not huge contributions to the bottom line, but they do make a difference. And when you put them all together, you can make a case for a pretty good quarter, and that's what we got. I mean, frankly, $1.2 billion in free cash flow generated in Q1 2025 by Newmont. And again, this is not going to be their best quarter in 2025. Their guidance is back half heavy. So Q3, Q4 should be significantly better than Q1. Now, obviously, knock on wood, a lot of that depends upon the gold price and Forex rates and maybe, what oil does, right? But if all things being equal, they should have better free cash flow in Q3 and Q4. So just think about what that means. I mean, if we're talking about the potential for this $60 billion market cap company to have over $5 billion in free cash flow in 2025. I mean, that's enormous. That's really powerful. And that suggests that maybe their $60 billion market cap is a little low, and maybe it should be closer to 75 billion or 80 billion. I'm not sure, but that kind of free cash flow, generation is pretty incredible. And it also means that they could probably raise their share buyback again. Maybe they pay a bigger dividend, or maybe they do some M&A, right? So it's going to be one of the big things in the sector, I think, as investors here. Obviously, like, the big trade is not in Newmont. Like, if I buy Newmont and I get it perfectly right, it goes from 55 to 75. I'm a genius, but I only made 40% of my money, right? We want to be thinking about how do we make 100% or 200% on our money. And the way you do that is think about what's Newmont going to do, right? With this potential $5 billion in new cash flow, if gold stays this high over the next year, what do they do with that $5 billion, right? And so that's what we want to try to answer. And if you can figure that out, Shad, please let me know and drop me an email. But I think M&A is going to be part of the answer. I think it has to be, because how much, they could do another 2 billion share buyback. They can increase the dividend a little bit, but at the end of the day, they're still going to be overflowing with cash. And I think investors want to see some growth at a reasonable price. But Newmont's been very challenged on the growth side. So is Bear. All these big gold mining companies are very challenged on the growth side. And so really the only way they can grow is through acquisition. And so I think that's just what we've got to see. So it'll be interesting to see how this cycle of M&A plays out here, especially against this backdrop of record free cash flow by the major global gold mining companies.
Well, and Newmont and Barrick are kind of particular cases in that they're so big, and you could argue now that Agnico Eagle is getting in that same kind of size factor, that it's very hard to keep growing without acquisitions or major acquisitions. That's why the majors have been cannibalizing each other. But when you look down at the next notch down at the intermediate producers in gold, you are seeing growth, and you are seeing companies that are able to have meaningful percentage growth in their production profiles because they're not so big. And so they can actually move the needle with one of their acquisitions in a bigger way. And they're still having good record cash flows as well. When I look at the mix, though, you think about some of the standout companies, Robert, and we've both put out charts to this effect to our subscribers. When you think about Dundee Precious Metals, when you think about Lundin Gold, Agnico Eagle, IM Gold, West Dome, Alamos Gold, K92, these things have been running really for 6 years. I mean, really since the end of 2018, they've been on big runs, and some of them are up 10x, 15x, even 20x in that time period, which are big moves that you would have expected in a gold bull market. But when you look at the rest of the gold producers, some of the other bigger names that people know, household names, some of the majors, and even some of the smaller ones, they haven't moved like that. They're not best in class. They don't have the best cost. Is it their chance to move? Because GDX is just now waking up. I would argue that just over the last month, it finally pierced through the old 2020 peak, which was 45.78. It got up to over $53 GDX. That's mostly the gold producers. That's the gold royalty companies and gold producers. It's hanging around 48 right now, but it's nowhere close to its 2011 high, and it still has a lot of room to really break the whole sector out. So do you think there's a catch-up trade in a lot of these other gold producers as they put out their Q1 and Q2 numbers this year? Is there more room to the upside? And some of the names that haven't moved, like the best in class, have moved.
Yeah, I mean, I do think there will be a catch-up trade later this year. I'm really unsure on the timing, if it's going to be, let's say, in the next month or the next 6 months, right? But there's definitely, I mean, as a gold mining bull market evolves, it does work its way down the food chain, and that's something that investors really need to understand. If they're like holding some junior explorers with gold in their names, and they're wondering why their portfolio was flat or maybe even down in the last year, well, they need to understand what they're owning, much higher risk with no revenues or cash flow, and those stocks tend to move in the seventh inning, the eighth inning, the ninth inning of the bull market. And if we're only in the second or third inning, well, you still got a ways to wait. It could be another 6 months, before the bull goes all the way down the food chain and pulls those stocks up. But man, when it does, and you get that, whiskey bottle in the shot glass, it is a sight to behold, and the moves can be tremendous. But I will say, Chad, while I can't guess the exact timing of how this bull market's going to play out, I will say that if the gold mining sector does cool off here, let's say over the next few weeks or the next month, maybe we get a sell in May and go away trade coming in here, and this pullback that started earlier this week goes further, it goes deeper, these stocks drop another 10% or maybe even 15%, I really believe that will be a tremendous opportunity, because what I can see how the narrative will go if gold drops more and the gold miners drop more over the next few weeks. Is going to be that was the top. 3,500 was it. You had your shot. It's never going to get any better than that. And sentiment's going to flip to pretty negative, again, on the gold space. And that's when we want to be buying. We want to be buying at lower prices when the crowd is more skeptical and pessimistic on these stocks. Gold is not in the headlines. And just like you're saying, the long-term picture. So look at the weekly charts, the monthly charts, even the quarterly charts. Like look at a silver quarterly chart, right? So the bigger picture forces in play here are super powerful and potentially very potent in terms of this next phase, right? So if Mr. Market really gives us a nice fat pitch here with some more downside and a bigger wall of worry here over the next couple of weeks in precious metals and mining stocks, I really want to encourage people that are listening to this to embrace it and really take more of a contrarian mindset. Don't look a gift horse in the mouth, and also just remember the old adage: the time to buy is when you won't want to, right? So when the sentiment is really negative and prices have been dropping, and people are on CNBC are saying that's the end of the gold bull market. It was nice while it was around, but now the world's great again and everything. Yeah, that's when you want to really step in. And just a final parting shot on that topic. Silver, I think, is the clue that we want to focus on here, because the miners, so the mid-tiers, the juniors, the junior explorers, those will really have their run when silver is outperforming and silver is breaking out. So that $35 level in silver, that long-term level, is so important here. And when that breakout does finally happen, then you'll know it's time, right? We're really in the real gold and silver miner bull market when silver is breaking out above that $35 level. But don't ask me when that breakout's going to happen. I just know that I'm long silver and I'm waiting for it to happen.
Yeah, I'm glad you went to silver, because anybody can do this, pull up a chart of the last decade and look at silver and look at the GDX. They're very closely correlated. That's because that's that speculative side of the business. People buy gold as an insurance policy, as a chaos hedge, but they get into silver and the gold equities and the silver equities for the leverage. And so when you start seeing silver leveraging the moves in gold, then you see the mining stocks leveraging the move in metals as well. So when you look at silver, just maybe another follow-up on it, Robert, and you look at the silver stocks, do you think that they have that ability to compress the gold silver ratio where it's been near 100 recently? Can we get down to, 70, 80? Do you care about that at all? Do you think that it's more of a just seeing a consistent outperformance of silver over gold? What matters to you where you'll know, aha, here we are, here's the breakout?
Well, it's interesting because the silver mining stocks tend to trade at a premium to the gold mining stocks. They trade at a premium, multiple to NAV. And, some people explain that as just, well, it's a smaller set of stocks. There's only like 20 real silver like miners that you can buy out there across markets. And so because it's a smaller set of choices for investors, they trade at a premium, right? So to some extent, the silver miners are already pricing in somewhat higher silver prices. But when silver starts to outperform gold, on a consistent basis. Like maybe we see 3, 4, 5 days in a row where silver is up 2%, gold's up 0.5%, or silver's up 1% and gold is even down 0.5%. Like there was a day earlier this week where silver was up and gold was actually down. That doesn't happen very often. I think maybe I can count the number of times I've seen that happen in my lifetime on both hands. That's just a sign that there's a change of character in the market. And that's what we really want to see. We really want to see silver start to outperform instead of underperform like it did earlier this month when silver kind of crashed along with everything else. No, we want to see silver, outperform. And I think that we're going to start to see that take place. And maybe we've already started to see that. And that will be really the time when, you see stocks like, I don't know, the silver juniors that we all know and love, like Dolly Varden, for example, is going to really outperform. You could see a stock like that maybe double over 3, 4, 5 months.
Well, I think a lot of people listening would like to see silver outperform gold just because it means the momentum's coming back to the space, and would like to see stocks like Dolly Varden double and a lot of the stocks in their portfolio double. So we'll keep our eyes peeled for that. Let's also work in copper. Dr. Copper, the prognosis of the global economy apparently is schizophrenic, Robert, because copper was up at a new all-time high, but nobody had time to celebrate it. It got up to 530 and some change intraday. It closed at like 521, so it was a higher close than the prior high, all-time high made in May of last year. And then shortly thereafter, once we had Liberation Day, it shot down to $4.03. So all of the move was erased immediately. It took the elevator down, and then it's now clawed its way back up to in the 480s. And so it's kind of had a V-shaped bounce here. What do you make of the good doctor?
Well, Shad, the good doctor is something that we want to pay attention to. The good doctor is a smart fella, and we want to tune into what he has to say. I'll just go back in time a little bit. Actually, you did talk about my Substack at the start of this conversation. I invite people who are on this call to go to my Substack, and I forget the exact date, but it was I think it might have been literally the last day of March. I blogged and I talked about copper, and I talked about how I was concerned that treasury yields were diverging from copper. So copper had been rallying, treasury yields had been slumping a bit, and maybe we're about to see a deceleration in the global economy, and yields were going to drop and copper would drop. That was kind of like my little thesis. And then literally like 2 days later, the whole tariff thing happened and things went haywire, as we know. And copper did that swan dive from 5 to 4 in like, I don't know, a week or two. It was an incredible move. I wish I had more size on that trade and I had profited more from that market call, but it just kind of happened and I didn't trade it perfectly. But that was interesting to see that unwind, because it was one of those market moments in time when I said copper's a short here, whatever it was at the time, 520 or something. It's this is too high. And a lot of this buying in March is front running the tariffs. And once he announces them, this thing is going to drop. It was an obvious trade. Very rarely do trades become that obvious. So now fade the scene, it crashed, and now it's rebounded much better than I think anybody thought. Because if you actually think about, Shad, like if the US and China are at a trade standstill, the two largest economies in the world, forget about all other trade deals and whatever else is happening around the world. If you just think about US and China, if they're not getting along and these countries are not trading, what does that mean for copper? It's got to be bad, right? It's got to my mind, it's got to be negative. And most likely the global copper market is going to go into oversupply. There's just not going to be as much manufacturing activity, trading activity, et cetera, et cetera. But here we are above 480. It snapped right back. So I believe Dr. Copper is cluing us in on the reality here, that the headlines, what we read and what the media wants us to think, is not actually the truth of what's happening. And the reality is that this US-China thing is more likely to be resolved in some way. I have no idea how. I have no idea what it's going to look like. Please tell me. I'm all ears. But the copper market is telling us that the situation with China is not as bad as it's being made out to be. Okay. And then maybe there's some other things involved here where, the COMEX copper price is trading at a premium to the LME price due to the tariffs and due to maybe a bit of a scarcity of copper in North America. But if we just look at it on face value, copper is trading very well. And it's telling us that things are not as bad as feared. And copper supply continues to be challenged.
When you look at the copper stocks, they really didn't believe the move higher in March because you look at something like COPEX, COPX, the ETF, or ICOP, ICOP, and neither one really got to the same level it had gotten to in May of last year. And so I thought it was interesting at the time that we were seeing copper break higher and higher for a couple of months, and the stocks really, the producers, the biggest producers of copper, weren't responding in the same way they had in the prior year. The juniors really never got off the mat on that move. Then we saw the crash in copper, as you mentioned. And then as we've bounced back, I've noticed a little more life in the copper stocks. So how are you looking at copper equities compared to the move in copper?
Conundrum, and they had like the Freeports and the Rio Tintos of the world. Yeah, they weren't trading great in Q1, and then they swan dove in early April, like everything else. But they've also V bottomed. These companies do not seem to be fully pricing in the prospect of $5 copper for longer. And that's something that I think we need to delve into. I think it's a longer conversation to try to unpack what's going on there. I think maybe there's some concern about tariff effects on these multinational companies. I mean, like Freeport has operations in Indonesia. Maybe there's some question about that if this trade war erupts into something bigger. Yeah, and just these are very complicated companies with complicated operations across many countries, right? And so I think maybe they're sort of paying a price for that right now due to this sort of restructuring of the global economy that appears to be underway. But there's no doubt that Rio Tinto, for example, I would think that if copper is stronger, $5 plus, the share price would be higher than it is today. But yeah, it's these are complicated companies, Shad, with a lot of moving parts. So I'm not exactly sure how to explain the share price performance in 2025.
Well, and I know that in reading some of your articles that you're very big on the earlier stage side of copper, looking at some of the copper porphyry plays as far as exploration plays, advanced explorers, and even some developers. And I will encourage listeners here to become readers of yours and dive into some of those companies with you over at your site. I guess just as we wrap up, Robert, I always like to end on the psychological trading side of things. You always have great advice to people to keep their heads centered on the main thing, keep the main thing, and not get stuck into the world of emotions that many people do. So, any advice that you have for people in this whipsaw environment and this uncertainty environment? What would you say as far as just some good trading advice in this kind of a stew of factors that we're dealing with?
Honestly, I think the best advice I could give in this world in 2025 is have a day job and have something that you like to do during the week that gives you a good income, and do your investment thinking on the weekends, like Saturday and Sunday when prices aren't moving around and there's not as many headlines out there, and do your thinking during quieter times when your mind is quieter and maybe the world's a little quieter, and try to be as unmoved as you possibly can be by the minute to minute noise of the world, right? Like some of the trends that are taking place in markets today are going to be trends for months and years to come. So why should we be changing anything, buying or selling anything based upon headline changes and tweets on an hourly or even daily basis, right? So we want to be thinking slower and longer term while the world is moving faster and faster and getting noisier and noisier.
Well, I think that's great advice as we head into the weekend here and giving people some downtime where the markets aren't moving or the numbers aren't flying on your screen. Take some time to digest the big picture view. Take a look at your portfolio, take a look at some of the bigger trends and, zoom out from the daily noise. Look at the longer term patterns on the charts, look at the longer term patterns in your portfolio and as far as your outlook a couple quarters out versus the daily noise where people get whipsawed out of position. So there's some great advice there, Robert. And Robert spends a lot of time writing about those kind of topics over at his site at Substack. He puts out videos to that effect on YouTube. We will put links down below to some of the different platforms where Robert puts out content. I recommend people check it out. Robert, always great having you on the KE Report, man, to dive into all these wild markets together. We talked a lot about the macro, the U.S. equities, bonds, the dollar, gold, silver, copper. Covered a lot of ground here. Always looking forward to the next conversation.
Thank you, Chad. I really appreciate it. Cheers.